Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
Welcome to our podcast, ladies and gentlemen. I hope you're doing well. I'm here in Houston with Hari this weekend. It's a pleasure to be here with him.
He flew down just for this, just to talk about Allison Transmission.
That's right.
Yeah. He likes you guys that much.
That much, guys. That much. I hope it's reciprocal.
Yeah.
Okay, we're going to be talking about part 2 of Allison Transmission. Before we do, give us a little disclaimer, Hart.
Yeah, so this is the Value Investor TV podcast. We are a podcast that helps educate you and entertain you and help you understand how value investing works. We are not financial advisors. We don't know your specific financial situation, so please consult with an advisor before making any financial decisions.
Excellent. All right, let's get right to it, Hari. So this is our continuation of our discussion around Allison Transmission.
Yep.
We talked about what it does, their competitive advantage, their relationships with customers, suppliers. We talked about all of that stuff in the previous episode. So please go check that out before listening to this one. In this episode, we're going to be talking about the financials, the management, and finally the valuation of Allison Transmission. And you might ask, why are you going through these things in this order? Well, that's because we're using our checklist. So if you don't have the checklist with you guys, please send us an email at info@valueinvestor.org to get a copy of our checklist, info@valueinvestor.org, or reach out to us on Twitter. Our Twitter handle is Value Investor TV. Value Investor TV, all one word, lowercase. All right, let's get to it. Right off the bat, the first question, is the company able to translate its moat into high returns on capital?
So we did talk about this on the last episode a little bit on if we look at Greenblatt's, Joel Greenblatt's magic formula, return on tangible capital is actually quite good. So they don't have a whole lot of property, plant, and equipment. They have a manufacturing plant in Indianapolis, and a lot of their assets really come down to the fact that they are a intellectual property company in many ways, right? So they have these lots of knowledge about how to build transmission that, for us to go and build, if we were to try and replicate their business, would cost a lot more than the $800 million that they have in property, plant, and equipment.
Mm-hmm.
Right? So they're a custom business in some ways, and that for us to replicate it would be very difficult. So that generally means that they have a moat, right? Because a moat, if it was easy to do, everybody could do it and compete with them.
Yeah.
That doesn't necessarily mean it's purely a moat, right? That they are protected, and we talked about that before. But so I do think that they do have high return on capital based on that, Joel Greenblatt's, methodology. So
you mentioned some numbers in the last episode. Could you give us the returns on tangible asset?
Yeah, so they had about $400 million in net property, plant, and equipment, and around $400 million in net working capital. They generated about $600 million in earnings. So what is interesting about their business is that because of the cyclical nature, they have a lot of fixed assets. The property, plant, and equipment isn't going to change year to year. Their working capital may fluctuate based on demand. But in good years, it's 75%. Like last year, 2018 was a very good year for them, and that's why it was such a high rate of return.
Yeah, that's crazy high number right there. Okay. The next question is, does the company have enough cash to maintain its business? It sort of goes in hand with sort of like the debt level and also ability to just operate within their cash flow.
Yeah, so I don't see any problems there. The company has about $2.5 billion in debt. They refinanced that after the 2018 annual report. So in the last few months, they've refinanced it, but it didn't change the amount. They just pushed back the dates for it. And they generate $600 million in free cash flow, so I'm not too concerned about that. Now the question is, in 2018 they had 2.7 billion in revenue. In 2014 they had put 2.1 billion in revenue. And in between 2015, 2016, 2017, it went from 2.1 in 2014 to 1.9 to 1.8 to 2.2 to 2.7. So even in good years, right, the economy is doing well in the last few years. It didn't really explode, right? And with their revenue being that, they were still struggling with, I think generating a solid amount of cash flow, because their net income at this point is roughly mirrors their free cash flow, because that's just how you would expect it to be for a mature business. And in 2014 they had 229 million in net income, and that tripled in 2018 to 639 million. So I think the last few years, they were benefited from some leverage, financial leverage on their earnings, because of they've made previously had made investments that are now paying off. The problem that we're seeing is that this is a cyclical business, and as you can see from 2014 to 2018, if their revenue drops to like 2.1 billion, that essentially wipes out a lot of their profit, right? And so, they have to be making more money, increasing the top line to really see any bottom line benefit. And that's heavily dependent on, the industry and the market conditions.
What's also interesting here is that it fluctuated quite a bit from 14 to 18. It just up and down, up and down. So again, going back to our cyclical nature, characterization of this company and the industry.
Yep.
Yeah. Okay. Next question is: does the company maintain reasonable debt level? This is important, obviously, for bankruptcy reasons. Does it have insurmountable debt level, or is it reasonable?
So I'd mentioned it was about 2.5 billion and 600 million in free cash flow. It's about 4 years to pay it off, which is a little bit higher than I'd like it to be.
Yeah. Tell us, what is your kind of threshold there?
I'd like it to be 3 or less, 3 years to pay it off or less of free cash flow.
Yep.
Now, it's not due until 2024, so it's not a huge deal. They're just paying interest on it, and they have time to pay it off. But I'm just not happy with the fact that if we hit a recession, that number could get very small, and free cash flow is at its peak right now. And they're actually anticipating this year to see a small decline in revenue.
So we might expect 5 to 6 years, possibly.
Yeah.
Yeah.
So it's not a great number from what I would like it to be. They have a little bit too much debt.
No, at this level, there's really nothing that was red flagged until now.
Yeah.
Would you say at this level, would you sort of punt on this, or would you continue?
I'm still interested, because I want to see, even though I know that it's a cyclical business, could they potentially make an acquisition that really cements their name in the industry? They already own 60% of the market. Maybe with a couple of strategic acquisitions, they could really jack up the price on their customers, right?
Sure.
So I don't see that.
Okay.
But I'm willing to continue.
Okay. All right. Let's go down the list again.
Yeah.
At this point, can company generate a strong amount of free cash flow from operations? We sort of talked about this, but more on this. Sorry.
Yeah. So 600 million in a good year. 2019, they're expecting a 3% decline in revenue, and free cash flow to go from 600 million to 500 million.
Okay.
So, they're saying between 550 and 600. Sorry. So, I'm not thrilled with that number. I mean, it's good, but it's not great, right? And so where I would see this is, for the right price, I'd still be interested, right? And so that's why we're going to have to wait till we get to the valuation to really know, is this cheap enough to buy?
Okay. That sort of closes off the financials aspect of the company and the checklist. Let's move on to management. This is, again, very, very important for value investors, as we are long-term investors. So the first question off the bat here Is management properly incentivized to protect shareholder interest over its own? For example, is the company owned by someone who founded the company or owns a significant portion of his or her net worth in the company?
Yeah, so the company was founded 100 years ago. So no.
The founder is still alive?
Founder is not alive and does not have any say in the... I don't know of any familial stake or anything like that. So I think the... so actually, I was mistaken. The cash flow for last year, free cash flow was $730 million.
$730 million.
Okay, so a little bit higher than I had been saying, but and the previous year before that it was $558 million.
Okay.
So 2017 it was 558, 734, and they're expecting between 550 and 600.
Okay.
So this year. So going back to management, I didn't see anything there that I really jumped out at me. There was not a big shareholder that I was would be relying on. So nothing there that kind of drives my makes me excited there.
Okay. And then, so the next question is, has management handled excess capital in a shareholder-friendly way? I think this is very important for our discussion here, and one of the reasons why we're interested in Allison Transmission to begin with. How has the company handled excess capital?
So in the last 5 years, in 2014 they had 182 million shares outstanding, and in 2018 that number was 134 million. So.
And did they buy back in one single year, or was it a sort of incremental change?
So every year they had significant buybacks.
Okay.
So 2014, 5 million shares, then 8 million shares, then 19 million shares, then 16 million shares.
Okay.
So that was a $2 billion authorization since 2016 to kind of help reduce this share count, which is good. I like to see that, they were trying to help repurchase. So in 2016, they had a $1 billion authorization in November. November 2017, they added $500 million to that. In 2018 of July, they had $500 million. And now they have around $400 million left on their share purchase. So they have not announced more, so they still could announce more to do buybacks. So there was a, we talked about share cannibals and how this was good. I think the problem that we have to really tackle here is there a share price? Are they buying at a cheap enough price to really make that share cannibalization work? Because if you took their net income from 2018 and you actually divided it by the initial the 182 share count that they had.
Hari took out his cell phone to calculate the share price.
In 2018, that would have been $3.50. It was actually $4.81. So you got an extra $1.30 just for
share buyback,
which is pretty awesome,
great,
right? So it's a fairly significant bump, 30% bump, and that accounts for a fairly large, reason for. I mean, their net income improved. It tripled. But you also got an extra bonus from from that. So, and that bonus is permanent, right? It continues going forward. So, you could make the argument that's a good use of capital. Could they continue doing that? Well, the problem is also related to their price, right? And so when we look at their valuation, I think what we'll find out is it's still really expensive, right? And they have very strong earnings growth for the last 5 years of over 30%, or close to 30%. But 130, million shares, at $45 a share, is it still cheap? And that's really where I want to, keep going and look.
Yeah, that sounds good. And then this sort of question, this question here, the last question under management, is management honest, open and honest? What do you think? Any red flag that you see? This is a hard one to answer.
It's a hard one to answer, and I didn't see any red flags by looking at their transcripts of conference calls and things like that.
Okay.
So nothing really big there.
Okay. I think we can move on to the next batch of questions under valuation. So Is there a significant margin of safety? All of this goes back to our valuation calculation. So tell us, is there a margin of safety here, you think, or what do you think?
Yeah, so this is where we get into the difficult question that I had here was, how easy is this to assign a growth rate to, right? Like if I'm going to look at this company, they grew by 30% a year because, they're hitting a peak, right? And I feel like this is a peak. Next year or 2019 is going to be a step down. I don't want to assign them a growth rate of, 20%. I can't use the 40% number that they grew in the last 5 years. And I don't think I can actually assign them. So I went with a conservative 0% growth.
Wow. Okay.
And I just said that, look, because I don't know what the next 5 years is going to hold.
That's
and this
very conservative.
Yeah, this is the problem with the business like this is that, and because I lack competence in this industry, I can't see 5 years out what is it going to look like, right? They're a very mature business at 100 years old. It's hard for me to tell that they're going to really, make a big splash in the next 5 years. And they're buying companies here and there, but they're pretty small acquisitions. I think the Q1 or last year, Q4 of last year, they bought a company, but it was like a $10 million acquisition.
It's small,
tiny businesses that they're buying. So I'm not too comfortable with giving them a huge bonus. And so I held that at 0. And they do have that $2.5 billion in debt that I have to assign. So I got a margin of safety price, around $15 a share.
And what is it trading at now?
$45 a share.
Okay.
So I would like to think that, if they continue the share buybacks, that they would do so at a lower price, right? And to some extent, they're maintaining that higher price that they've already had by the existing share buybacks.
Yeah.
So, they have $400 million left if they continue to authorize it. I just think it's a poor use of their capital at this point. They have to pay a lot in interest expenses, so why not reduce the interest expense, which it's not terrible, but it's still there.
Before
and if the share price drops, because it will probably drop as the cyclical part of this picks up, price goes down, because last 2017, you could have had this stock for less than $30 a share.
Yeah.
And so now we're much closer to that margin of safety price.
Yeah.
Buy it, hold it, build up your capital war chest, pay down some debt when you need to, and then buy back a big chunk of your shares.
Yeah.
That to me would be a better allocation of capital. And so the reason that I would, pass on a business like this is I don't feel like the capital allocation is as shareholder friendly as it could be. They are a cannibal. They are buying back shares, and they've reduced their share count by 25%. But it's not enough that they could have done a lot more with their price had they been more efficient with their share buybacks.
Yeah, absolutely. Okay, well, I think at that point, we're sort of at the end of the checklist, but it seems like a glaring sort of I don't want to say error, but this is a red flag for us in going down the checklist. If you see something like this is a red flag in terms of actually moving forward with an investment. And that's why we do these checklists. We have to go through all of them one by one and methodically analyze. And at the end, we find out that the valuation is too high for them to be doing buybacks.
Right.
And this is the case especially with debt level that they have. So I think at this point it's safe to say that you would pass on Allison technology or transmission.
Yeah, and I wouldn't say at the right price it wouldn't be necessarily a bad investment. Maybe at the trough of the next cycle you'd see a better price. At that time if they buy back shares, you may have a better, you have a tailwind behind you. But right now, not enough to really make me interested.
Yeah,
so.
Yeah. Well, this was an interesting case study where you have this is a nice contrast between NVR and Allison Transmission in that they're both share cannibals themselves. They're wanting to be share cannibals, but one is doing it the right way, and one is maybe not so. And I think go ahead.
I mean, just to be fair to NVR or to Allison, NVR is not necessarily doing it because they're allocating it well. It's just their share prices never go too high.
Yeah,
right? So,
yeah. So, so I think this was an interesting case study. More to come, guys. More to come. But any last words before we close out, Harry?
No, if you want to tell them about Apple Podcasts and and the website too about emailing us.
For sure, yeah. So we talked about this in the previous episodes. We are in the process of sort of building out a website for you guys. It's a database that will contain financial information about publicly traded companies, and it'll also have a curated list of companies that fit sort of the descriptions that we talked about for share cannibals and for other things like spinoffs and things like that. And so as we were building this out, we wanted to build it with a community. We want to build it with you guys. So if you are interested in beta testing our website, our product, please reach out to us at info@valueinvestor.org. We'll keep a running list of beta testers who are interested. I think that would help us. And also, I would like to add that we're trying to get our word out there. We want to let you guys know about Value Investor TV. And one of the best ways to do that is by Apple Podcast rating. It's a rating that a lot of these sites use to index podcasts, and if we have more ratings on there, it would really help us to get ourselves out there. So if you could take a minute or two to just go into Apple Podcasts and give us that 5-star rating, that would help us out tremendously. And tell your friends and tell your family and tell your acquaintance about the benefits of Value Investor TV.
Strangers you meet on the street. Tell them too.
Just grab them and say, do you know about Value Investor TV podcast?
Yeah. They'd like to know.
Okay. We'll close this one out. And we'll see you guys on the next episode. Thank you guys for joining.
Yeah. Thank you.